Welcome to another edition of How to Build Lifetime Cash Flow Through Real Estate Investing. I'm Rod Khleif, and I am thrilled that you're here. You're going to get tremendous value from the gentleman we're interviewing today. His name is Dana Robinson, and he wrote a book and hosts a podcast called Opt Out Life, and about really, well, I'm not going to steal his thunder. I'm going to let him tell you what that means. But he's got a pretty extensive real estate background, has owned a couple of property management companies for a couple of decades, has been a broker for 18 years, has had 90 doors in the apartment arena, and now is got more of a lifestyle focused attitude and about life. So welcome to the show, Dane. I'm glad you're here, brother.
Thanks, Rod. Thanks for having me. Happy
Absolutely.
to be here. Hopefully I can bring some stories that help people at whatever stage they're at with real estate.
Awesome. So let's talk, let's start as we normally do, just by having you do a much better job about talking about your history and how you got, maybe as it relates to real estate, and then how you got to where you are right now.
Yeah, I'm a lawyer by trade, but while I was in law school, I actually was the on-site property manager in Mission Beach, which is a coastal community that's a lot of short-term rentals, college rentals, and that sort of thing. And so, I played the muscle, and my wife played the nurse, and we co-managed this apartment complex for a realtor and her brother, and kind of learned the business. And then once I was a lawyer, about the time second or third year down. My colleagues were buying bigger houses and nicer cars, and I kept my old Volvo and squeezed every penny I could to get a rental property, and bought a condo down in that same beach community.
Where is this? Where is this again?
Mission Beach is San Diego's kind of largest vacation rental market. It's a little peninsula with maybe 2,000 vacation rentals and another 1,000 long-term rentals.
Nice.
Condos. It's got bay on one side, beach on the other.
Nice.
So yeah, it's a cool place to own, because San Diego has, 3 major universities. And so there's a lot of the capacity to rent 9 months to students and then 3 months to vacationers. And
Nice.
So we learned that trade. And right after buying that property, found out that a friend of our old boss was selling his property management business. And so we bought it. It was, swung everything we could into that, and ended up the owners of a struggling property management business. And we kind of got our hands around that and spent the next 4 years growing it. We doubled each year, and streamlined the business. We went all online in an era when that wasn't happening quite yet. And, also while owning that property management business, had parlayed the sale of that condo to a 32-plex, a 33. And very quickly had a partner that helped us get a 48-plex just down the street from that. And then with the realtor who set that deal up, and I bought 9 units down the street from that. So ended up with a collection of apartments in downtown Phoenix.
This was Phoenix. Okay.
Yep. Okay. Yeah. Downtown Phoenix, which was a pretty flourishing market. Prices were rising, and it was.
When was this approximately?
2004 through 7.
Okay.
We bought before we had any sense that there was a bubble, and then rode through that crazy downturn in the market. We actually entitled 2 of the properties for high rise. One my partner knew an architect, and we thought, well, maybe we'll add value. Well, I was the managing wing of the business. He had the vision, and so we spec'd up high rises for those, and actually had them sold in escrow July of 2007.
Ouch.
And
Ouch. Yeah. And then the world stopped.
It stopped. Yes. we were about to share our respective shares of a $12 million net profit.
Oh man. Well, you don't want to compare memos with me on that whole debacle and that time frame, but that is painful. That is painful. Wow.
Yeah.
So what did you do at that point?
Well, at that point, I buckled down. My partner wanted out because he was in a lot more deals that he needed to sort of like extricate from. So he wanted out, and I bought him out, and I stayed in and kind of fought my way through the downturn. And, one of the buildings, my accountant named the building Jerry Springer, because we had, tenants that were crazy, and managers that were stealing drugs out of the tenants' properties. And
Oh, good God.
I had
You can't make this stuff up.
Oh yeah. Yeah. The best was when I thought I finally had the perfect manager. His girlfriend was a drinker, and I didn't realize it, but she was taking his keys and sneaking into units and sipping the vodka out of people's freezers.
Oh my God.
And, she was smart for a while, just enough, so people didn't know. And then eventually I had several people call me because she got caught in one of the units with a beer in her hand.
Oh,
and,
good Lord.
And everyone then checked their vodka levels and realized that they weren't drinking as fast as their vodka was disappearing. So so for the ensuing 6 years, I just buckled down and held on to the properties and, kind of learned to manage them efficiently, learned to deal with the drama. I talk about that birthday when my sister, who was helping manage one of the properties, called to get my credit card number because they were digging a hole in my driveway and needed $5,000 immediately to continue digging that hole. I learned a lot between the property management business, managing for other people, and then managing a substantial number of my own doors. I had this feeling that maybe I was either going too big or not big enough. I mean, and I, that in between was a difficult spot to be. Didn't quite have the economies of scale that I think I really needed to I don't know where that is. Maybe in Phoenix, it would have been 300 doors, where, you're running a flourishing management business of all of your own properties, and maybe you can expand into other management. But it was definitely, I looked at the math, and I was doing better on one oceanfront condo financially than I was with all of those properties.
No kidding.
With each one. So just take 33 units. I did a financial analysis, compared the 33 unit to a $1.5 million oceanfront condo that my wife managed in her sleep with no drama. And she was like, "We're doing better on this condo than you're doing out there with all that work you're putting in on that property." So by the time we sold, we eventually sold when the market recovered, and we did pretty well. I mean, good story about playing the long game on real estate is there will be times when it goes down, and even in that worst time, there's a recovery that you can hold on for. Yeah.
If you can hold on.
Yeah.
Don't ask me how I know.
Yeah. Yes.
So, okay.
I can tell you that I had some liquidity at the beginning of the downturn.
Yeah. And that was your saving grace, right?
It was, but I mean, I bled it down to the last little bits. Mm-hmm. So I'll tell, for those that survived through that as well, those that didn't, if you ran out of oxygen in 2011 or 12, even, you needed to hang on to 13 or 14 to get that rebound. So,
right.
It was tough times, but the lesson to me wasn't necessarily the biggest lesson. Really wasn't the downturn and holding on, and the long-term value of real estate. Those are all there, but it was the realization that a smaller collection of properties might perform just as well or better. And so when I took this break, I took a little sabbatical after I sold two of the properties, and I went to Bali, and I, kind of like recovered a bit.
How long were you in Bali?
14 months.
14 months.
Yeah.
Wow.
Yeah. One-way ticket. We took a one-way ticket. Our daughter was in college. I put everything, at that point I didn't own and still don't own the home I live in. I mean, I own real estate substantially, I think, but not the home that I live in. So we just got out of the apartment we were renting, put our stuff in storage, and went to Bali with a one-way ticket.
Wow.
And it gave me a chance to reflect. I had a couple of books, everybody's got a book in them. So it was my opportunity to kind of stretch my brain a little on that. And I started writing, and this book I wrote that you mentioned, it's called Opt Out, is, a reflection on the tools that I used to get, I guess, what I'd call like an alternative life, an opt-out life, a life where you don't have to punch the clock, where your businesses don't own you. And a big pillar to the opt-out life is real estate. But, I had to come to terms with this idea that real estate can become a monster that owns you just like a job or a business.
Sure.
And I had that, with all those units.
Well, you were managing too, which managing is a thankless job. And Tenants don't call you when they're happy, and owners don't call you when they're happy. There's a real burnout with that as well. So I can see how this all worked up, and then you're in Bali, and the clouds part, and there's butterflies, and you're like, you know what? What have I been doing? And I get it. Wow. Okay. So please continue. I interrupted.
Yeah, no, it was a great interruption. But it was the realization was that the math would have worked better if I had just bought a fourplex over the 30, let's just take the 33 and the 48 plex. Each one was probably worth about the same as a fourplex in San Diego. And I live in San Diego. So, right. I postulated this theory and even wrote about it in my first draft of the book that the opt-out approach to real estate was to have just enough, just enough. I mean, I wanted the maximum passive loss that I could get.
Passive loss? So you're not focused on income, you're focused on loss?
Well, no, but you want to maximize that loss because it's a gift from the government. So if you've got $25,000 a year, now, if you own a lot of real estate, I mean, you reach a point like where I was with 90 units, I was more than 500 hours a year. I didn't have a passive loss limitation. So if I incurred, and I did some years, 6 figures in passive losses, when you depreciate the property, all those losses, you write off against your other gains. So, I mean, I had 6 figures of usable loss from my real estate while I was a full-time broker, owner, manager. Mm-hmm. But coming back, I didn't want to do that full-time. So, well, what's the gift that the government gives the regular guy is $25,000 a year in passive losses that you get to write off against your other gain. You want to get that. And if you have a little real estate, you don't maximize that. If you own a condo, that's not enough. If you own 90 units, you have a lot more losses than you can even use, and you may never use those. They just carry forward. So I wanted to maximize that passive loss. Obviously, get a property that I could get to. That was a big lesson, was getting properties that I could get to easily. So buying local. In your
backyard.
In my backyard. Mm-hmm. And having some management experience would enable me to have something that I would consider passive, but that I still would manage. I mean, when you've managed dozens and dozens of units and
right.
Properties for others, having what I have now, which is 2 fourplexes, is
do that in your
incredibly
sleep.
fast. I can do it in my sleep.
Right.
The turns are fast. The contractors I've had relationships with for forever. You never get ripped off.
Right.
And you can, you build, I'm very personable with the tenants, and they appreciate that rapport and don't take advantage of it. And so between my wife and I, we don't have one text maybe every week about an apartment matter. It's so easy. So we're saving on management fees. We're saving on contractors that rip you off. We're maximizing our passive loss. And the fourplex is actually a sort of underappreciated property because of the financing. You can get conforming conventional financing for fourplex.
Oh yeah. If you live in it, you can get 97% financing. I mean,
absolutely.
Incredible opportunity. And we talk about it a lot on this show. So, you're talking about doing just enough. Now, I realize the argument for buying just enough real estate to maximize that 25,000, but what about on the income side?
Yeah, I mean, the income side, I'll give you an example. For the first fourplex I bought, I put about $85,000 into rehab. So I bought it for $1,150,000. Yeah, about $1,150,000, put $85,000 into rehab. And I raised the rents across the 4 units, $2,700 across the 4 units. As soon as I was done with the rehab, I did a refi. I got the garage. No one wanted the garages, and someone was using them for free. Two dual garages.
Wow.
I took one and used it for my personal storage. That saved $175 a month. I rented the other one for $175. Actually, half of one. Another one's now for rent for another $175. So and between not spending money on management, being able to keep an eye on my contractors, raising the rent, renting the garage, saving money on the storage. I mean, I'm like about $3,500 ahead from a cash flow standpoint on the property.
Nice.
And at this point, I'm using that for another property, but once I refinance that property, I'm going to pour all of that money into paying down this property, and it will get paid off in the next 15 years. I've got a 30-year amortized loan at, I forget, 4.5%.
It's not gonna float. There's no balloons. That's the beautiful thing about residential financing is it's 30-year fixed, and you can accelerate the payoff like you're describing here. And there is nothing better than free and clear real estate. I mean,
right,
and as good as it gets.
You can also take out a HELOC on a 4-unit that you usually can't do if you've got a five or more units, because at 5 or more units, you're in commercial lending.
Right.
You get prepayment penalties. You've got points on closing. You can't take out a second mortgage. So to me, the kind of, I did a speech at a mastermind a couple of weeks ago about real estate. And I thought it occurred to me that my approach was, I called it the opt-out approach to real estate, because it gives you maximum freedom with maximizing the benefits of real estate from a cash flow, pay it off, easy to finance, all of those things. I realized it was kind of the Goldilocks approach, that Papa Bear maybe's got too much, or at least my version, my 90 units at Papa Bear was too much. My buddy who has one condo is is Mama Bear. That's just too little. You don't get your passive loss. If you look at a 20-year horizon, one condo is not going to set this guy up for life.
Right.
I'll tell you what, though, in 15 years, my 2 fourplexes will be paid off, and they're going to be throwing off, in today's dollars, $7,000 a month each. So I'm not that worried about whether my 401k performs. And, as they go up in value, if I see other opportunities, I could borrow a second against one, take out some money and buy another property if I wanted to. But I feel like I've at least got the opt out. And, by the time those are paid off, I don't know what retirement is, because I don't think I could just do nothing but golf. But I like the idea of having $14,000 a month in today's dollars coming out that I don't have to do that much for, on top of whatever else I'm doing for fun. Right.
So this strategy of yours, which is, lifestyle centered for sure, which frankly, I even struggle with, you try to, especially at my age, I'm 58. You want to look at life through a lifestyle filter and, enjoy. I mean, life's about being happy and enjoying as much of it as you can. So talk about some strategies besides, real estate's a pillar. What are some other strategies for maximizing, minimizing how much time you work and maximizing the enjoyment?
Yeah. So my approach to income is that you get income from side gigs. And then if a side gig's performing well, you might turn that into a business. So I've got 3 pillars: side gigs, business, and real estate. That's how you make your money.
Okay.
A lot of people I know, they're making, say, $7,000, $8,000, $10,000 a month from side gigs. They're like, I don't want a business. It's kind of like my approach to real estate. I don't want 90 units again. Right. So their approach is like, look, man, I've run businesses. I don't want to scale and grow. I like my lifestyle. So they've got a side gig. They invest in real estate, and that is all they're going to do for the rest of their lives. Mm-hmm. And then I've got these call them expense hacks. So the income hacks are business, side gig, and real estate. Right. The expense hacks are make your house an asset, cashless currencies, and
let's drill down on these. Okay. So make your house an asset. What does that mean?
Make your house an asset means look around and think, the house you live in is a liability, right? You need to make money from somewhere else to pay for it. Well, what can you do to make it an asset, generate some income from it? If you're urban, that might mean renting your garage out for storage to somebody, make you $200 a month. If you're in a place where it's a destination, it might mean, I've known people that are single guys that own condos and they rent them out on the weekends on Airbnb.
Right.
And they're just like, look, I'm going to New York anyway, so I just put it on Airbnb for the weekends. I have a lawyer friend, and he was divorced. He had a dog. And he lived near Point Loma Nazarene College. And it turned out a lot of parents wanted an Airbnb room, and they were fine taking like a room in a house. So he was making $1,000 a month. Wow. By just having, 2 weekends a month, guests that were parents that would come. And sometimes he'd stay. Sometimes he would leave them and say, hey, can you watch my dog? So he was turning his house into an asset. And, there are a variety of ways to do that. You can permanently build what I call a Fonzie flat, something in the attic that you rent out short term. I owned, well, I didn't own, I leased a house that had a flat over the garage that someone used for storage. And it had a bathroom. So I just cleaned all the storage out, and it was coastal. So I was making $3,000 a month from the unit above the garage from just vacationers that wanted to stay there. And my lease payment was $5,250. So I was paying, and this is equivalent to a mansion, on the ocean. And
Nice.
So more than half of my rent was covered by that Airbnb. And if I'd owned the place, I would have done a second unit. If I'd owned it, I'd have built one somewhere else in the structure. So make your house an asset to me means, don't just make the house something you live in that costs you money. If you want to get ahead and have passive lifestyle, sort of the opt-out life, do something to make your house an asset. And
Okay.
sometimes that's as simple as renting it while you take a vacation. I mean, I have a good friend that's got a multi-million-dollar house in La Jolla, which is a fancy zip code here in California. And he's going to take 3 months off, and he's like, I don't care what they do to my house. You can't ruin it enough to make up for the fact that he's making 10 grand a month for 3 months. And they said that will more than cover his family's vagabonding for 3 months.
Cool.
And when they come back, the house is still there, and he's not going to leave the few precious family heirlooms out. So that's the strategy for make your house an asset.
Okay. And then what's the next one?
Cashless currencies. Cashless currencies are those things a lot of people don't think about that they sometimes already do, like trading some service for another service. I call it trading things of unequal value. If you do consulting and someone is in the wine business, they can say, hey, here's a case of great wine, and I need 2 hours of your time. And this swap is tax-free. You each get value that's greater than what you spend. So if you say give someone $600 in your time as a consultant, if it's unused otherwise, then that time isn't really worth $600, right? But you're getting full value, and you're getting $600 in wine. And the wine person paid $300 for the wine, right? If they're a wine wholesaler or something,
right?
So they're getting $600. So each person's getting a sort of dual benefit of this swap, and I call it a cashless currency. Not to be confused.
Bartering. Yeah, no. I used to do that in a big way back in the day. I used to have this business. I've had 24 different businesses. I had a business that leased rooftop cold air balloons, and for grand opening sales, things like that. Oh, yeah. And I would trade those for tons of stuff. I mean, tons. But awesome. Just do a couple more. I think this is interesting enough. I know it's not multifamily, guys, but I know a lot of you, certainly long of tooth like me, look at this whole lifestyle thing. So I hope I'm certain this is adding value. So let's continue with just a little more, if you don't mind. Yeah.
So the third expense pillar of my philosophy is scavenging, and it might be a dirty word, but I am always sort of looking for underappreciated value. I've done this with real estate. I've done it with cars. I mean, I drive an SL 500 that I bought from an 87-year-old man that had only put 20,000 miles on it,
Wow.
And he paid $100,000 for it, and I bought it for $17,000. So, to me, I don't want to sacrifice lifestyle. I don't want to be, the penny hoarder kind of like, trying to figure out how to make something for the kitchen that's going to save me $5. I want to get nice things. Well, for example, if you go to an estate sale in a Rancho Santa Fe or Beverly Hills, right. Yeah, you're gonna get a La Crusade pot that costs $300 or $400 new for like $20. Mm-hmm. So whether the scavenging is little stuff, those little things that you want to make your life better, or something like a car, or even real estate, this scavenging to me is like, look for that underappreciated value and get rid of this, like, you need to own the fancy things. You need, this mall mentality where you just roll out and pay full retail. Then all that hard work you're putting into making money with these income pillars, you're squandering it on something that you could still have those things, but you need to channel your inner scavenger.
Love it. Love it. So let me ask you this. Let's digress for a second. If you could teach school children one thing, and that's not being taught, what might it be?
I think it would be things that trigger entrepreneur, the entrepreneurial spark.
Love it.
When I was in 5th grade, I had a teacher that created a mini society the second half of the school year. And we'd spend, I think it was one day a week, might have been more than one day a week, for the last couple hours after lunch running the society. And it was all to trigger entrepreneurialism. She wanted you to run a little business, sell some things, sell a service. My buddy and I set up a bank, and we sold wallets that I made with my mom's sewing machine.
What an incredible teacher. Holy cow. It's a shame there's not more of them out there like that. What a brilliant, brilliant strategy. Love it. So if you could go back, this is a question I like to ask regularly. If you could go back and tell your 20-year-old self something, what might you do differently?
Geez, I would have bought more real estate sooner.
Yeah. Right.
Absolutely. And I think not worried as much. I mean, that's right. The thing, that people do when they're younger is that the older self looks back and you're like, I'm here. I survived. Roof over my head. I didn't run out of food to eat. When you're going, when you're going through the storm, what's the analogy? Keep going. Or you're going through hell, keep going. That's Winston Churchill's quote. Yeah. No, I love that. Great advice. Great advice, Dana. Now, let's talk about advice. What's the best advice you've ever received? That is a really good question.
Yeah, and I'm not. You didn't prepare for these. I'm throwing some stuff at you weren't ready for. So,
yeah, okay. I'll give you the best advice I received, and probably didn't really hear that well. I was a first-year lawyer, and the partner that started the law firm was an entrepreneur himself and had done really well. And I was getting involved with a small deal, and I came into his office, and he looked at the deal, and he just shook his head and said, "Don't do this. This is a waste of your time." He said, "Now, I would tell you, be more cautious in general." He goes, "I could paper the walls of this office with stock certificates that are worthless." And he said, basically, I know I can't talk you out of getting involved with business and being an entrepreneur. I can see that. But, his wisdom was, don't make the mistake of going in with so many ventures that you could paper the walls of your office when you're 50. And I kind of came close. I heard him. I've heard that in the back of my head, but sometimes not soon enough. So it's with that entrepreneurial zeal, you want to just get involved and get into a deal and throw yourself into it. And it's going to be big. And the news that mentor was telling me was a whole bunch of those are going to flop. And, to get success, you've got to see those failures. At the same time, I could have been more cautious with some of what I've done with my time and money.
Fantastic advice. I mean, I've started 24 businesses, several worth tens of millions of dollars. Most have been spectacular, flaming seminars.
Yeah.
So we fail our way to success. Bottom line, but that's great advice. And what I heard was the power of focus and not rushing and not taking the time to really, evaluate what it is you're getting into. But then again, the flip side there, for those of you that are analytical, is not getting caught up in analysis paralysis either. But now that's great advice.
Yeah.
Okay. Well, listen, my friend, you've added a ton of value today. Guys, his book is Opt Out Life, and the podcast is the same name. Check it out. And, really appreciate you being on the show, Dana.
Thank you so much for having me. I love talking about real estate, and look forward to talking to you about it more.
All right. Take care, my friend.
Thanks.
Thank you for listening to the Lifetime Cash Flow Through Real Estate Investing podcast. If you've enjoyed the show, please take a minute to visit iTunes and leave your comments. For more resources or to connect with us further, please visit our website at rodkhleif.com. Tune in next week for our next show.